Good afternoon, everyone. Welcome to Nova 401k Associates webinar on 401k loan and distribution basics. Today's webinar is eligible for Texas CPA credit. Right after the webinar ends, you will see the survey pop up if you are needing CPA credit. We have also added the slides as a handout. Just click the handout drop-down on your GoToWebinar panel, and you can download and save the file to your local folder. Today's presentation will be presented by Team Leader Don Carr and Assistant Team Leader Lisa Rodriguez. If you have any questions, please type them in the questions box and we will go over them at the end. I will now hand it over to Don.
Thank you. Welcome everyone to our webinar today on 401k loan and distribution basics. And we're going to be going over quite a few things regarding loans and distributions in your 401k plans. The information in this presentation is general in nature and is not intended to be a substitute for legal or tax advice. Please consult a qualified professional such as an attorney or an accountant if you need legal or tax advice. As Jasmine mentioned, we are offering Texas CPA credit, and our provider number is 009820. In order to get the credit, you must have registered individually, be present for the entire webinar, and complete that evaluation form that pops up after the webinar is over. You'll receive your certification within 1 week. Our agenda today is we're going to start off with distribution basics, and we're going to talk about different types of distributions, including the more recent COVID-19 distributions, which were mostly just for last year, but I did want to just go over them a little bit because some of that does affect and have implications for future years. We're also going to talk about special tax notices, special taxation issues, and then we're going to move on to loan basics, talking about maximum loan amounts, including the special rules that were just related to the CARES Act, and loan defaults. We're going to talk about how vesting comes into play regarding loans and distributions. We're also going to talk towards the end about avoiding common problems that we see come up with loans and distributions. And we're also going to go over cybersecurity and how to keep your plan secure. The objective today is to help you to understand the mandatory and optional distributions that can be made from 401k plans, to also be able to identify loan provisions and loan requirements in the 401k plan, and to understand how vesting applies in regards to loans and distributions. Starting off with some basics on distributions, once the money goes into a 401k plan, it must meet certain criteria before the money can be withdrawn. Some of the common ones are termination of employment or retirement, attaining age 59 and a half for in-service distributions, hardship distributions, death and disability distributions, and rollover distributions. So we're going to talk about each of these different types in a little bit more detail. As I mentioned, the CARES Act presented some different distribution options, which were over and above the usual distributions that we saw. And I just wanted to touch on this briefly because these are no longer available, but some of the provisions of them could relate to future years. So this was for people who were eligible for a special distribution due to adverse financial consequences as a result of COVID-19, such as furloughs, layoffs, reduction in hours, business closure, lack of childcare, and really it was opened up to a lot of other factors that could possibly come into play. As it was, we relied on participant self-certification to be able to take these type of distributions. So the CARES Act actually opened up a new type of distribution event and allowed participants to take up to $100,000 from their plans. It also allowed a full withdrawal to be taken if their balance was under $100,000. And this was only in place for January 1st through December 31st of 2020. But as we'll see on the next slide, we are still dealing with some of the implications of this even in 2021. These type of distributions were eligible for special tax consideration. So even if the person was under 59 and a half, they were the normal 10% penalty was waived on those type of distributions. So that was one big advantage to those distributions. Also, they were not subject to the normal mandatory 20% withholding. They could opt actually for no withholding. That could be a problem for people now that are going to file their taxes because they may actually owe taxes on those distributions that they had taken out last year. And the one big thing that is going to affect future years is for the participant, the regular income taxes on those distributions could be spread over a 3-year period. So the participant could pay all the taxes in 1 year, or they could spread it over 3 years. So that was a big advantage to those type of distributions. And, we'll still be kind of having a lot of things come up even though the time period for those has ended. Also, the participants were allowed to repay the distribution within 3 years. So it's too soon for us to really tell how much this is going to happen. I'm not really sure how often this will happen where a participant may want to repay that distribution that they took. So those repayments could actually be made to any qualified plan or IRA to which it is eligible for a rollover contribution to be made. The repayments will be treated as rollover contributions. And then the participants would need to go back and amend and refile prior tax returns. So it's a lot of effort on the part of the participants to actually be able to repay these distributions. But it's important for you as a plan sponsor to be aware of this option. So in case a participant comes to you in the next year or 2 or 3 even, and wants to repay a distribution that they had taken under the CARES Act, just to let you know that this is actually out there and is a possibility. So moving on to some of our regular type of distributions, the termination of employment or retirement is the most common one that we see. It's a voluntary distribution by a terminated participant, and the money cannot actually be withdrawn until a date following the termination. So we often want to wait until their final payroll contribution has gone into the plan, which could actually, be a couple weeks after their termination date. The idea being that you don't want to have residual distributions happening after the original distribution if you can avoid it. Sometimes participants will be really anxious to take their money out as soon as they terminate employment, but it may not always be possible until after that final payroll is put in. The involuntary forced out distributions. This is when you can force out terminated participants from your plans. And usually you'll have a $5,000 threshold, although it's possible to have $1,000, but we really don't have too many plans that are set up that way. It basically means if you have a terminated participant that has a balance of less than $5,000 in the plan, $5,000 invested, they can actually be forced out of the plan. And the idea behind that is just so you won't have your plan with all these small balances in it. And we actually will help you with accomplishing these force outs. So with the force out distribution, it's instead called an employer-initiated distribution. If the participant fails to make a distribution election, unrelated rollover balances may either be included or excluded in determining the $5,000 threshold, and that's going to be based on your plan document. Most of the time, I see them being excluded. But you really would have to check with your account manager in order to double check whether those are being included or excluded. The plan document must also indicate what force out limit is being used. Most of the time you'll see 5,000, but occasionally you will see 1,000. And balances must be automatically rolled over into an IRA if the balance is over 1,000. So what we've actually done with most of the plans is, depending on what their record keeper is we set up these force outs to be automatically rolled over to an IRA, no matter what the amount. And the reason for that is we're trying to avoid the small de minimis type of distribution going to the participant. I think my next slide kind of talks about that a little bit more. If they're under 1,000, you're technically allowed to distribute that in cash. But in that case, the participant would have to be mailed a check for 80% of the balance, and then the federal withholding would be another 20%. The problem that we ran into with that is that you'll have a lot of uncashed checks. And those are really still part of the plan if they remain uncashed. And it just kind of creates a additional administrative headache because you're stuck with these uncashed checks. And this will happen a lot with these low balances. You might have somebody with a $20 check or even less, and they may never cash that check. So we try to avoid that whole thing by changing most of the plan documents so that even distributions under 1,000 are being rolled over to the IRA. And if you're unsure about this, you can always check with your account manager and they can tell you exactly what your cash out provisions are. But the reason behind it is we're trying to eliminate this issue that had come up quite a bit regarding uncashed checks and all these small balances. The nice thing about the rollovers to the IRAs too is that whenever this person eventually does turn up and want their money, it's just sitting there for them in the IRA, and they haven't, hasn't been taxed or anything. So at that point, they can do whatever they want with the money. You can also always contact our distributions department for more information, or your account manager. Distributions at nova401k.com is the distribution email address. Probably the next type of distribution that we see a lot is the age 59 and a half, also in-service distribution. This is optional, so your plan does not have to allow this, but most of the plans we see do allow it. It allows an employee to take a distribution while they're still employed if they're over 59 and a half. Sometimes there can be restrictions on the source type, like deferral, safe harbor, match, profit sharing. So you're going to need to check your plan document for that. But the early withdrawal penalty does not apply because the person's over 59 and a half. So that's normally a 10% penalty. But it doesn't apply because they're over the age. They are still subject to the regular federal income tax. Another type of distribution that comes up a lot is the hardship distribution. It's also optional in your plan, so you're not required to offer it, but a lot of plans do offer the hardship. It allows an employee, even under 59 and a half, to access the 401k account in the event of an emergency. It's normally still going to be subject to the 10% early withdrawal tax. There are some exceptions to that, but just as a general rule, it's going to be subject to the 10% early withdrawal if the person's under 59 and a half. And it's also going to be subject to your regular federal tax withholding. For this type of distribution, we do require hardship documentation. And on my next slide, I'll be going through the different types of hardship reasons. So most of the plans are set up to allow what's called safe harbor reasons. And these have expanded a little bit over the years. There used to be 4, and they've kind of gradually been added on to. But they're the purchase of a primary residence, to prevent foreclosure or eviction from the primary residence, for unreimbursed medical expenses, for post-secondary education expenses. That could be for either the employee or for their dependents. Casualty losses, that's when the home might be damaged in the event of hurricane or tropical storm, or it's something of that nature, and it's called a casualty loss. So they're going to need receipts, demonstrating the damage that may have been done to the house. And also, one of the newer ones is burial expenses. That could be for different relatives of the participant. Also, the newest one is hardship as a result of a federally declared disaster. So a lot of times when there's some sort of disaster, like all the big storms that happened a couple months ago, like in the Texas and Oklahoma area, they were considered a federally declared disaster. So there could be special hardships regarding those. The hardship rules had changed back in 2019. So I just wanted to just briefly go over the changes, and in case some of you may still remember the old rules and comparing them to the new rules, because even though it was 2019, they're still considered pretty new. It used to be you had to take all available plan loans before taking a hardship, but that's no longer required. You no longer have to take loan before taking a hardship. Also, previously, you were not allowed to take the investment earnings on the employee deferrals, but now those are eligible for hardship also. And there used to be a rule that you had to stop contributing to the 401k plan for 6 months, and that was removed also. So even if a person takes a hardship distribution, they no longer need to stop contributing to the plan. And the plan documents were all updated for these new rules. So they were actually effective back in 2019. Sometimes employer contributions may be available for a hardship, but that's really going to be dependent on the plan document. You'll mostly see employee contributions available. Um, and then sometimes you will see employer contributions. It used to be that you could not do a hardship from Safe Harbor, QNAC, QMAC contributions, which the main one that a lot of people would have would be Safe Harbor contributions. But they may now be available for hardships, depending on how the plan document is selected on your plan. If you're unclear, it's probably best to check with your account manager just to see what type of hardships your plan allows and what sources you're able to take hardships from. And there is a certification that the employee has to fill out to demonstrate that they have the financial need and they qualify for the hardship. It's probably one of the more time-consuming distributions with our distribution group, just because a lot of times we don't always have the correct documentation when it's first submitted. So sometimes we may need to go back to the participant or to the plan sponsor to get more receipts or information on the hardship. So if everything's not in 100% correct information or in the right order, not in good order, these can sometimes take a couple days just to go back and forth to get the documentation from the participant. Unfortunately, I know the participants are often wanting this money immediately, So it just would speed things up for them a little bit if they had, all the correct documentation they would need to take the hardship. A rollover source type of distribution. This is when a participant has rolled money over from another source, like say another qualified plan that they may have been in, or even a rollover. This goes into what's called a rollover source. Um, an unrelated rollover source, which means it was unrelated to this plan that it's in now. That may be distributed at any time if the plan document is set up that way, which most of our documents are set up that way. And the idea is that it just allows participants to access those retirement funds that they may have rolled into this plan. And it actually encourages participants to roll over money into your 401k plan because they know that they could take that money out in the future if they needed it. For death distributions, these are distributed according to the beneficiary designation, and the beneficiary forms are maintained by the plan sponsor, which is normally the employer. So this is a problem that comes up, unfortunately, a little bit more than you would think, where someone may pass away and there's no beneficiary designation on file. So that can cause a lot of confusion, as to who the beneficiary may be. For married participants, it would automatically go to the spouse. If they, unless they had a beneficiary form that named someone other than the spouse, and even then they had to have spousal consent to name that other beneficiary. So occasionally you'll see that. Not very often, actually, that you will see a spouse sign off on naming another beneficiary. But if there's no beneficiary form on file and the person's not married, it becomes a little bit more confusing because then we need to go by the plan document. It states a certain order of distribution, which is normally like spouse, children, parents, siblings. And it just comes a little more complicated. So as a plan sponsor, we kind of just would encourage you to try to get these beneficiary designations signed every year, just because certain things may change from year to year. Someone may get married, or they may get divorced, or they may have a child. And just to make sure that these are completely up to date in case anything should happen. It also just makes the processing of the distribution a lot quicker. It's never as quick as a regular distribution because we do need a death certificate and we need a beneficiary form. So just by its very nature, it's going to take a little bit longer than an average distribution. But if there's some question on who the beneficiaries are, it's just going to take that much longer. Required minimum distributions are due normally at the end of the year. And some of you may remember, if you are used to having employees with the required minimum distribution, that requirement was waived for 2020 due to the CARES Act. So in 2020, we didn't have to do any required minimum distributions. Some employees still did them as optional, but for the most part, there were no required minimum distributions. So now we're back to the requirement again for 2021, and it's an annual requirement that certain employees have to begin taking money out of their 401k plan. And the rules on this changed a little bit recently too. It used to be age 70 and a half, and now it's been increased to age 72. So it normally applies to terminated employees who reach age 72, or to greater than 5% owners, even if they're still employed, who reach age 72. Now, there are some exceptions to that, like if they may have reached age 70 and a half under the old requirement, they'll still be required to continue taking the RMDs, but for newly eligible RMDs, the age is going to be 72. So non-owner employees, someone who's not a more than 5% owner, they may delay the RMD until the year of the termination. And approximately in October of each year, we start working on these RMDs, and we start going through the plans and seeing if there's anybody eligible for an RMD. And then we start sending out notifications to the plans of any trying to get more information on some of these employees. Like, for example, you may get an email asking if different employees are still employed, or if they may have terminated employment. And these are due by the end of the year, so they're due by 12/31. We always try to make an effort to get the information out to the plan sponsors by Thanksgiving, just so we're not running up against the holidays. And if we try to get them all done before Christmas, basically. Quadros or qualified domestic relation order. That's a situation that comes up with a divorce when the spouse of the participant basically has a claim against part or all of their 401k plan. So it allows a portion of the account balance, and sometimes even 100% of the account balance, to be distributed to the ex-spouse. The rules on this are really complicated, and it's by no means a one-day process. We often will get a draft of the quadro, and then it still needs to be approved and signed off on by a judge. And the whole process sometimes can take, it could actually take several weeks or months even if we're waiting for the final approved quadro. But if you do hear of a participant that is going to be having a quadro or has a quadro, you should let your account manager know, or the distribution team, because we need to be aware of that in case someone tries to take a distribution or a loan like in the middle of a quadro going on. It can cause some problems. Years ago, most of qualified plans needed spousal consent to be able to take distributions, but at this point, most 401k plans do not require spousal consent to take a distribution. And even on the ones that do, it's not required for distributions less than 5,000. A couple of the plans that are still subject to spousal consent would be defined benefit plans, or plans with old like money purchase pension plan money in them. They might have been a merger with the 401k plan at some point in the past, so they may still be subject to these spousal consent rules. But if you're not sure, if you have an older plan and you're not sure if that applies to you, you could always ask your account manager to look into it. The special tax notices, it's information that the participant has to receive when they take a distribution. It includes information on how to defer taxes on the distribution, basically by rolling it over. And it goes into the different taxation of distributions, like the 20% withholding or the 10% penalty. And a lot of times, if people do the distributions online, this information is all on the websites. But there is an actual paper form that has to go out to the participant if they're doing the distribution on paper. Just to go over the taxation of distributions a little bit, for what cash distributions, when they go to take their money out without rolling it over, that's going to be subject to the 20% federal withholding rules. And then the 10% early withdrawal tax or penalty, that's actually something that they have to pay when they do their tax return. So that's not part of the withholding. The 10% early withdrawal or penalty tax if they're under 59 and a half. That's something they actually have to do when they file their tax return. At that point, when they take a cash distribution, that distribution becomes taxable income. So it's going to be subject to all their regular taxation. So the 20% withholding is just a withholding tax. So it's going to be based on whatever their federal income tax rate is, and then if they happen to live in a state that's subject to income tax, it's going to be subject to the state income tax as well. For rollover distributions, this allows the participant to defer the taxation. So they might roll it over to an IRA or to their new employer's 401k plan, and that allows them to not pay taxes on the money now, but at some future date when they take the money out of the IRA or the other 401k plan, they may have to pay taxes at that point. And rollover distributions are not available for hardship withdrawals or for the RMD distributions. Obviously, the RMD distributions are intended to be taxable, so that's why they're not eligible for the rollover. And hardship is supposed to be because of financial need, so that's the idea behind those not being available for rollover. At this point, I'm going to switch the presentation over to Lisa, my co-presenter, and she's going to start off by going into the loan provisions, the loan basics, and some vesting issues. Thanks a lot. I'm going to turn it over to Lisa.
Thanks, Dawn. Can y'all see my screen?
Yes, ma'am. Click slideshow.
Slideshow.
And then from current slide. And then click display settings at the very top and swap presenter view.
Okay, perfect. Okay, so the next section we're going to go over is in regards to loan basics. So and it's in regards to participant loans from 401k plans. This is an optional plan provision. You are not required to offer loans within the 401k plan, but we have seen a lot of plans actually offering loans within the plan. So if you don't offer this and you are considering, you can definitely do so. Now, if you go this route and you allow for loans, now this feature allows employees to access their 401k funds. It also does encourage participation. I should say higher participation because of the fact that they can actually access their money in any given point in time, especially if they, for any reason, they need, some sort of money. They have the ability to actually request a loan from the plan if the plan does allow for loans. Now, some of them do have like a restrictive provisions that you can tie to the loans. For example, you could limit the sources available for loans, but for the most part, loans should be available, or I've seen them available for all sources. So restrictions really don't apply in that situation. Usually plan sponsors, if they allow for loans, they usually make loans available across the board, all sources. Now, loans are not taxable distributions simply because the participant is going to be repaying back the loan. The loan repayments do have to be repaid back via payroll deduction, and they do have to be paid back on an after-tax basis. And like I said, if your plan does not allow for loans and is something you're interested in, an amendment would be required to add the feature into the plan, or in the event you say, you know what, I don't want to allow loans any longer, then amendment would be required to remove the feature as well. There are certain limits when requesting a loan. The maximum loan amount participants can actually borrow is 50% of their vested account balance. not to exceed 50,000, and that 50,000 is also reduced by their highest outstanding balance during the last 12 months, and that's for those participants that actually, keep on requesting loans. So we do take into consideration their highest loan account balance within the last 12 months. So it does get a little tricky. Therefore, our distribution department is available to help calculate the maximum loan amount. Some participants think that if they pay off their $50,000 loan, that they can request another $50,000 the following day, which is not the case. The whole point of having this restriction is in order to prevent this from people doing that. Now, what NOVA recommends for some of the loan provisions is a maximum of one loan outstanding at a time, a minimum loan amount of $1,000, and we do require loan repayments to be payroll deducted, like I said, and it has to be on an after-tax basis. Spousal consent is generally not required when taking a loan. So the CARES Act that was recently passed did allow for certain limits in regards to loans. It allowed for higher loan limits. Usually a participant's loan is limited to the lesser of 50,000, I should say 50% of their vested account balance and 50,000. But during COVID last year, for any loans made from March 27, 2020 through September, the limit was actually increased to the lesser of either 100,000 and or 100% of the participant's account balance. Plan sponsors were actually allowed to rely on the participant's self-certification for these COVID loans. Again, these COVID loans are no longer available, but that we wanted to keep this slide in there in case, some plan sponsors actually did come across and wanted to know what the, higher limits were. Okay, so moving on to some of the loan requirements. Loans have to be at a reasonable interest rate. We have determined that a reasonable interest rate is usually prime plus 2. This is what we currently use on our documents. So by saying that is that I believe the current interest rate is 3.25. So 3.25 plus 2, if the participant were to request a loan, then the interest rate would be about 5.25%. Now, the interest rate can change from time to time, but I believe it's been at a steady 3.25 for the most part. The maximum loan term is 5 years. It can be longer for residential mortgage loans, but you do have to provide documentation in the event you want to request a loan for a mortgage. It must be repaid through payroll deduction. I don't keep stressing on that. And it does have to be on a post-tax, after-tax basis. This allows the plan sponsor to confirm that the loan is being paid back since it is through payroll. So we don't accept like checks from participants. Loans generally become due upon termination of employment. This is a downside if you terminate. Then the loan will become due at the time of termination. So that's the only downside. Other than that, participants, like I said, can take loans and repay them throughout their active duty with the company. Okay, so what happens if a loan is not followed, or they don't follow the terms of the plan? So it could become a prohibited transaction, and it could become a taxable distribution subject to like early withdrawal penalties. If these loans requirements are not followed, there are certain correction programs through the IRS Of course, there is a fee to make these corrections. So best thing to do is to try to follow the loan schedule as it should be. They can select from 1 year all the way through 5 year term. So as long as they're making the correct loan repayments, every pay period, whether it be biweekly, weekly, semi-monthly, as long as they keep doing the loan repayments, they should be fine. Now, in the event you come across anybody who has stopped loan repayments, they're still active, we do have contact your account manager. We do have a special department that can help you correct this in case you do have participants that have actually fallen off the loan schedule. We can definitely help you correct that. There are certain loan fees that may apply when participants are requesting loans. One of them can be like the loan initiation fee. It could be from Nova, and it could be from the vendor, record keeper, wherever the money is at. There could be also annual or even monthly maintenance fees that I've seen by the investment company, and participants bear the cost of any loan request. Plan sponsors will not pay any of those fees for the most part. Okay, so usually when a participant applies for a loan, they need their money as soon as possible. Some ways you can definitely help expedite the loan process is to maybe understand the process from your specific record keeper or investment company, knowing, should you request a loan online, should it be a paper format. The actual online loan process, if your plan does actually offer that feature, it is a lot quicker. So definitely recommend if your record keeper allows to apply for a loan online, definitely go that route. Requesting like an ACH instead of a paper copy is also a lot faster. If you actually do request a paper copy, it does take a couple of more days to process. Not to mention that there has been situations where it gets lost in the mail. So in order to avoid any of that, we definitely do recommend to request the ACH direct deposit. Participants should allow sufficient time to receive the funds, especially if they are aware that they may need a loan on next date. Loans used for like a down payment on a house. I mean, participants usually know they're interested in buying a home, and that they usually may want to request a loan from the actual 401k plan. Submitting the loan application early in the process is definitely better. Just keep in mind, it usually takes probably about, say, maybe 5 to 7 days to make the process. And, if they select ACH, that would be a lot quicker instead of a paper copy. So definitely, if the participant is aware that they need a loan, submitting the proper documentation and requesting it, early rather than later, if they know they need a loan by X date, is definitely helpful for both the plan sponsor, record keeper, and the participant. I do have a couple examples here that I wanted to go over. So in this first example, participants A, current vested account balance is $2,000 and is requesting a loan for $1,000 to be repaid back in 2 years. The plan document allows for one outstanding loan at a time with a minimum of $1,000 withdrawal. So 50% of the participant's vested account benefit is $2,000. So $1,000 would be approved since he does have an account balance of $2,000. He would get the $1,000 loan request that he has requested. Okay, so in this example, let's say participant B's vested account balance is $2,000, including an outstanding loan of $400, and he's requesting a new loan of $1,000 to be repaid back in 1 year. The plan document allows for two loans outstanding at a time with a minimum loan amount of $1,000. 50% of the participant's vested benefit is $1,000, but the available loan is reduced by the $600. So that would be, 2,000 times 50% equals $1,000 minus the 400 that he had outstanding, means he has $600 available. So in this scenario, the loan request would not be approved. Now we do have some loan recommendations to avoid loan defaults. Only allow for payroll deducted loan repayments. This assures that the loan is being, repaid back on time. Set up loan repayments immediately with your payroll system, or provide this information to your payroll provider. If you don't do it in-house, definitely, make sure that your payroll provider is informed. Review the start date on the loan schedules that you have for any participant that has a loan. Enter a total goal amount. For example, total number of payments times, the payment amount. This allows the system to actually determine when the loan is actually paid off. So I know some systems do allow for that. If someone takes a leave of absence for certain reasons, sometimes those loan repayments can be stopped. Definitely notify your payroll provider if it's done outside of the office, so they can know when to stop and when to restart those loan repayments. Loan defaults can be costly, so definitely try to avoid them at all costs. Now, like I said, missed loan repayments could cause a loan default. The participant options to avoid a loan default is to make a lump sum payment of the total missed payments, adjusted, of course, for any interest. He would make it to the record keeper immediately, and the remainder of the payments can resume as scheduled as long as he makes those missed loan repayments. Another correction would be to re-amortize the loan, but it has to be within the 5-year loan term. So repayments have to be made by the end of the date of the 5-year term. That typically means that the loan repayments would more than likely increase to avoid the loan default, and to make sure that the loan is actually repaid within the time period. Grace period. There is a grace period for missed loan repayments, and it's usually the last day of the calendar quarter following the calendar quarter in which the first payment was missed. So let's just say a participant missed their January loan repayments, and that means they would have until the end of June to make that correction, and that would be their grace period. So anybody that missed a payment, let's just say January through March, would have through the end of June to make that correction because of the grace period that's allowed. Now, special exceptions for loans extensions due to COVID-19 were allowed. I believe they had the ability to suspend loan repayments up to a year for anybody that was affected by COVID. Now, moving on to the vesting. Vesting is important when it comes to distributions and loans. The general definition of vesting is an employee's ownership right to the benefits in the plan, which is accrued over the time based on the vesting schedule designated in a legal plan document or adoption agreement. So definitely look at the plan document. If you're not sure what the vesting schedule is, you can definitely look there. For example, employer money types are generally subject to vesting. Those would be like discretionary match, or even a profit sharing contribution. If the company has made any of those types of contributions, they would be subject to a vesting schedule. 100% vesting is required on safe harbor, QNIC, QMAC, and rollover contributions. And of course, any money that the employee puts in, whether it be pre-tax deferrals or ROC deferrals, those are always 100% vested. So some plans calculate the vesting differently. The most common is the hours method, where a year of vesting service is calculated on a plan year basis, and that's typically on a calendar year plan. Now, 1 year of vesting aid is credited for each plan year. An employee works 1,000 hours or more within a plan year. Vesting is calculated from the original date of hire, not the date a participant becomes eligible for the plan. And the IRS, hours equivalency method is available for computing hours in the event the company doesn't track hours. So we could use the equivalency method to track hours. In the event that the company doesn't track any hours, we can use that. The other vesting method would be like the elapsed time method. Under this method, a year of vesting service is calculated on an anniversary date basis from the original date of hire. So it doesn't matter how many hours they worked when using the elapsed time method. Okay, and I have provided an example here. So say participant A has been credited with 2 years of service with ABC Company. They're on a 3-year vesting cliff and has the following account balances. So the employee has employee deferral contributions of $5,000. They have employer match contributions of $3,000. And if we take into consideration the 3-year vesting schedule, 1 year equals 0%, 2 years equals 0%, and on year 3 they would become 100% vested. So let's see. So the participant would be 100% vested in their deferral contributions. The match contribution 0% and 0% vested on the profit sharing. If they had, well, in this case, they didn't have profit sharing, they just had a match. So there would be 0% vested on the match portion. So the total distribution to the participant in this example would be $5,000. 100% of the match source is transferred to the forfeiture account because the participant is invested based on the 3-year cliff schedule. Once it's transferred to the forfeiture account, the company has the option to either use this money for future contributions or use it to pay plan expenses. Okay, so in this example, participant B has been credited with 4 years of service with XYZ Company on a 5-year graded scale. That's 20% vesting per year and has the following account balances. So has employee contributions of $2,000, employer profit sharing contributions of $1,000, and safe harbor match contributions of $1,000. The next slide will go over the breakdown. Okay, so the deferral and safe harbor contributions are always 100% vested. So they would be 100% vested on what they put in their safe harbor. The profit sharing contribution in this example, the participant is 80% vested because the participant has only completed 4 years of service, and you actually need 5 years to be 100% vested. So the total distribution to this participant is $3,800, $2,000 for employee deferral contributions, $1,000 for the safe harbor match, and $800 or 80% for the profit sharing contribution. $200, the $200 that is not vested or 20% of the profit sharing source will then be transferred to the forfeiture account. And like in the prior example, any money that's unvested would be available in the forfeiture account to be used for future contributions, or the plan sponsor could definitely use that to pay plan expenses. Okay, so now let's go over avoiding most common problems with loans and distributions. So we sometimes do receive actually forms not in good order that we could help avoid. So for distributions, sometimes the participant may be missing a signature, and sometimes we do find that the plan administrator's signature or the authorized signature might be missing. Date of termination is often omitted. So if any of these, definitely pop up with any forms that we actually get within our distribution department, they will be contacting the primary contact at your company to actually, request any missing data. So for the loans, we have sometimes needed to request like the payroll frequency if the loan form doesn't have it. Now the loan term, whether it be 1, 2, 3, 4, 5 years, we do find that sometimes, that's missing as well. We also need like the next payroll date so we can know when the first loan repayment will start. For hardship, sometimes the documentation is missing. So we do have to contact plan sponsors to provide, documentation in regards to hardships in order to continue processing the hardships. So definitely, like I said, these are some of the common problems we've seen when receiving forms. So if any of these items are missing, our distribution team will definitely contact you to request these items. Okay, so now moving on to our cybersecurity measures. I've listed some items that tend to have, confidential information. For example, census files, deferral files, payroll files, address files. They usually have like social security numbers, other, dates of birth, dates of hire. So we do recommend that if you're submitting any of this data, definitely use our website to send us the files, send it directly to your account manager versus an email, just to protect the confident, just to protect the data from the participants. Non-discrimination testing files also include our compliance testing packet, which include like the ADP, top heavy, 415, 402G, and all those contain confidential information as well. For the most part, we do mask social security numbers whenever we create these testing files, and we do upload this information to our website. We do not send it by email to help protect the privacy and sensitive information that these files may have. Other tests, any additional tests or any additional reports that actually have to be submitted to the client, or you're working with your account manager, for the most part, will be uploaded to our website as well. This is just an extra precaution measure that we actually take in order to protect the participants' information. In regards to distributions and loans, same thing, definitely recommend that you send them through our website. In the event you actually have to send them through email, I definitely recommend maybe using some sort of password and contacting your account manager and giving them the password if you're unable to use the website. Tax forms such as W-2s, we all know it contains social security numbers. K-1s, Schedule Cs, that all those forms contain confidential information. Let's try to protect that, and sending it to your account manager, either encrypted through via email or by using the Nova's website. And just to sum it up, here is, I've included a link of our website. So once you're logged in, you should be able to upload files directly to your account manager by selecting their name. And everything is included under the Secure File Exchange. We do have a Secure File Exchange tab. Once you select that tab, it would allow you to actually, select whatever file from your computer and then upload it to your account manager at that time. Now, we do use encrypted software. I believe we use Proofpoint for our firm. If you have an encrypted software that you can definitely use to send this information, if you're using email, then definitely make sure to do that to send us any confidential information. New plan contacts must be authorized by an existing contact before being added to our system. So if maybe you're, moving on to a different department and someone else is actually taking over, the 401k administration, and you were actually the primary contact here at, primary contact that Nova would contact you directly. Definitely make sure you notify your account rep, make them aware that, either you're leaving the company or you're moving on to a different department and who the new person is that will be taking over, and we'll make sure to update our files to reflect who the new person is. Now, Nova does have mandatory training for all our Nova staff. Every quarter, we do go over cybersecurity measures. Nova does have a password policy that all our passwords have to be changed at least every 90 days. And this is, like I said, is just an extra security measure that Nova takes to protect our data. Okay, so and just as a reminder, if you need CPA credit, make sure you complete and return. Well, I think there's a pop-up that comes up at the end of the screen. So just make sure that once the webinar has finished, a pop-up should pop up, and make sure you complete that evaluation form to get credit. And then you should receive the certification within 1 week via email, I believe. Jasmine, did we get any questions?
Hi, Lisa. We actually did receive one question, so I'll go ahead and read that for you now. With the CARES Act only applied for 2020 401k distributions, and no other act has been signed for 2021 in regards to 401k distribution, correct?
Right, that's correct.
Okay, well, that's the only question that we've received. So do you or Don have any closing comments for our participants?
I don't.
I'm sorry, I could just say thank you for joining us.
Oh, yes, definitely. Thank you.
Yes, thank you everybody for joining us today for our Loan and Distribution Basics webinar. Please note the survey will pop up right after the webinar and for you to complete if you need Texas CPA credit. So just be on the lookout for that. The certificates will be sent out in 1 week, and a recording of this webinar will be made available on our Nova YouTube channel by the end of next week. If you have any questions, please reach out to your account manager and they will be happy to assist you. And for any other questions, please email us at webinars@nova401k.com. Everyone have a terrific Thursday.